Of course, this is not financial advice and for entertainment purposes only. Investors, we have a very special guest, Mr. Perry F. from Blossom. Now, if you guys want to join Blossom, it will be in the link in the description of this video and in the pinned comment section. And he has been retired since September of 2023. He has an over $1.6 million portfolio and earns roughly $40,000 per month, or just about $10,000 every single week in terms of dividends, as well as premiums, or should I say distributions from his portfolio, from YieldMax, GlobalX, Harvest, Defiance, Hamilton, and so much more, with YieldMax contributing to the yield, or should I say the highest portion of your income from your over $1.6 million portfolio. And one fun fact about Perry is that his dividend yield is 35.9% as of right now, with YieldMax, like I said before, contributing to that yield the most from MSTY, from LFGY, Pelty, CONY, Whitebit, NVIDIA, etc. Your portfolio, Perry, is valued at over $1.6 million, so congratulations on that. Average income every single year being just shy of $500,000, or about $480,000. You have a super big resume in terms of investing, a successful resume. You are retired. You have been investing for quite a while now. And so I'm going to throw it back to you on how retirement has been for you and how are you feeling about being on the channel.
Well, first of all, thank you very much. It's an honor to have you invite me to this. So that was a great invite, and I appreciate coming here to talk to you about it. Am I liking retirement? I absolutely love retirement. I don't know if there's anyone that wouldn't like it. The funny part about retirement is you think you retire so you can actually relax, but I'm busier now retired than I was when I was in my career. So basically that now my new full-time job, my wife calls it my full-time job, is to become now this investment management guy. So literally doing this now has become something from what I never did before I retired. I was one of those guys like everybody else that basically went to the Royal Bank or Altamira or whoever the major bank you went to there, and here's my $1,000 of free money. Go put it into your balanced portfolio, and maybe someday I'll see it when I retire, type of thing. So I was really, and again, so I don't want to go all the way to history. Like I was starting to invest when I was 17. I bought my first penny stocks and made a bunch of huge mistakes there and came and went through it. So I sort of dabbled with investing, but for my entire adult life, I was like everybody else. It's just basically, whatever you could scrape $100 or $1,000 for the month from free spending and put it into your RRSP so you can hopefully have enough to retire, by the time it's time to retire. But I've never really liked it. Like I remember back, and again, Altamira is one of the first companies they don't exist anymore. They're one of the first companies that I actually did invest into RRSPs. And even back then, I was like, all mutual funds. And I turned around and I said, you guys know there's a train coming. You see that there's a market correction coming. Why can't you short this? Like why? I mean, I don't want to do it, but why can't you short some of your positions and get ready for it? And they're like, we can't. Mutual funds can't. They must be a long position only. And I was like, well, so it's always bugged me, Marcos, that they knew they had the skills, but they didn't have the ability because of the tools they were using to do it. So you get to 2008 and all of a sudden, your beautiful portfolio was growing. Then 2008 comes and basically pulls it down 15%, and it takes another 3 years to rebuild. And it really bugged me all that time until it was about mid 50s. And I finally said to myself, no, there's got to be better. Like I want to dabble a little bit more. I want to sort of experiment myself. So almost about only a year before I retired, because like you said, I retired September of 23. In September of 22, I actually said, I've got all my mutual funds. I've got my balanced portfolio. I'm going to take one of them, my non-registered, and I'm going to transfer it into a self-directed RBC brokerage account. I'm going to play around. And I've seen the interviews from Adriano and Paul and several others, and they all say the same thing. They played around, and it's so funny. Not only did they play around, but they all actually went after the same stocks I went after. So They're like, oh yeah, I bought some Suncor because I wanted this, and I want some Enbridge, and I bought because they were all looking for the same thing. They wanted to get a good, steady flow of income. And so I was floundering. My first 3 or 4 months when I decided to take myself directed on my own, I was getting nervous. I was like, I'm not doing any better than my mutual funds are doing, because yes, they're good, but they're also bad. And I still remember it was January of 2024. I was still working because I work from home, and over here, over to the side over here, I always had my BNN news, business news network up and running. And these advertisements start coming in from Hamilton on HMAX. Like they're saying, oh man, get 13% return on yields on this, like 13%. I can't get more than 6 or 7 on my, Enbridge and that. So it's sort of like, I'm interested in this. Can't be true. It's too good to be true. Like everybody else says, it's too good to be true. I'm not the kind of guy, Marcos, that basically just says it's too good to be true and just throw it to the side. I want to prove that it's too good to be true. So I started looking. Of course, you start doing Googling, Marcos, and you know what happens when you start Googling an ETF and then you start Googling a covered call ETF, then people's names start showing up. And of course, one of the first ones showed up was Adriano talking about passive income investing. I was like, oh, there's a name to this. Okay. But I've still only seen one ETF. I actually started researching. People talked about erosion and this, no, it's not going to work and stuff. But again, I don't believe, listen, I'll listen to YouTube videos. I'll take in the information, but I will validate it. I will not turn around and say, oh, well, they say there's erosion, so I'm not touching those. There's erosion. I go to the horse's mouth. So I actually did a half-hour interview with a fund manager from Hamilton and said, look, I'm looking at interest in this, but I need you to answer some of these questions about erosion and stuff like this. And they did a great job explaining, some of this rock is basically there's good rock and there's bad rock. And we do it because there's a tax purpose for it. So we have to call it that because that's what the IRS and the CRA says. So I started saying, okay, I believe enough to buy my first one. So HMAX was the first ETF I ever bought as part of my journey into passive income investing. And I went basically from that first ETF to basically transforming at that time I had about 800,000 in RRSPs. That was before I retired. All 800,000 was basically converted over those next 6 months over from this to this new strategy that I have now. The reason I went up to a lot more is because when I retired in September, I had a pension. So the pension turned around and said, okay, Perry, you've got options. What do you want to do? Do you want to commute it? Do you want to do 50% for the rest of your life? And I looked at it, and my company pension wasn't great. It wasn't indexed. So basically, because it wasn't indexed, yeah, they were paying me $2,000 in this month. But by age 90, since it wasn't indexed, that $2,000 will only be about $700. And I'm not being able to leave anything for my kids. And I said, okay, this decision is easy. I believe in this income strategy enough. I'm going to commute. It was a tough decision because you're making a decision on leaving an assured income to go to something that you've just now learned that it's good. But I did pull the trigger when I retired, and I basically cashed out my pension. That was another 400,000. So that's why when I actually started, which was November, I'll say my strategy was mature and starting to evolve to being more like care and feeding in November of 2023, just the month after I retired. So that was my history, Marcos. Long-winded, but
You would say that you are a passive income investor, a high income cover call investor, correct?
absolutely. I've actually been thinking about this for several months on the philosophy of what I am as an investor. I am an entrenched passive investor. Because I am retired, income is my number one priority. I do not care about growth. I know it really ticks off a lot of the growth investors. If my NAV is down 10%, that's okay for me. At the end of the day, my priority is income. I believe in buy and hold. Because you might ask me the question, well, Perry, you've got one ETF here that's a real dog. Like I know you might point out CONY, for example. I'm down 57% on CONY. If you look at it in a different way, Marcos, I don't look at the cover call ETFs as total return on investment. I look at them almost like a super juiced up annuity. If I look at every covered call ETF as an annuity that will pay me for as long as it can last, yeah, okay, it'll erode on its income over the 3 to 5 to 7 years. Again, CONY, I'm just using that as an example, Marcos, but CONY Yeah, it might go down. It might actually reverse split like Tesla has done and almost wants to do it a second time. But it'll never go to zero because as long as the underlyings are there, it'll always have some value. The only way it could go to zero is if coin disappears. So, okay, yeah, my yield is not the 120% on CONY that it was, a year ago, but it's still, if I look at my numbers right now, it's still generating me 40% yield. That's yield on cost. So I'm looking at yield on cost. My yield on cost on CONY is 40%. I have almost no Canadian ETFs that do 40% yield yet. If I look at these as annuities, I turn around and say, yeah, even if it goes to 15%, even if it goes to 10%, at the end of the day, it's like having an old truck in your barn. And you know what? It's not the greatest truck, but it still hauls soil, right? So sorry for being long-winded on that too, but I wanted to actually explain why my philosophy is buy and hold, because I won't get rid of an ETF unless there's an opportunity to do it. And last week was one of those rare opportunities where I actually sold a couple of my covered call ETFs. Actually, I sold positions in 4 of my covered call ETFs to take on a new covered call ETF, which is now, you said 40,000. Thanks to my transactions in July, my average is going up to $48,000 a month now, not 40,000. So I'm happy with the transactions I did in July.
When you're looking at which ETFs to pick in your portfolio, you said you want prioritize income, high yield. When I think of that, I think of YieldMax. When you were looking at YieldMax, what were your thoughts? Did you think it was a too good to be true, scammy product, or was it a product that would fit great in your portfolio?
Well, initially, YieldMax is, I guess, the king of the ultra. I won't even call him high yield. I'll call him ultra yield because I really consider the Canadian covered call ETFs to be the high and very high, like the Harvest ones that have just come out, the single stock ETFs from Harvest. They tend to be very high because in the Canadian landscape, if you're exceeding 25 to 35%, that's good. That's very good for a Canadian covered call ETFs because they tend to be more conservative. So I'll call that the ultra high yield ETFs. YieldMax was the king. I did buy. Actually, Tesla was one of the first ones I did buy. And I did it. Yeah, it was too good to be true. So I dipped my toe in it. Like, you named all the different ETFs I have. I have 29 ETFs. I totally believe in diversification. Like, I know some say, why are you doing it? You're spreading yourself too thin. No, I like having large diversification because if I want to experiment with something like YieldMax, which is like too good to be true, I can go and take a 2% position in it. And even if I lose the 2%, yeah, so what? If it turns out to not be too good to be true and it actually is true, I am actually winning and I can now grow from a 2% position target state because I do target weighting on all my portfolios. So if you remember, you looked at my video on my spreadsheet, all my ETFs have a target weight, which is arbitrary. I pick it based on what risk I want to take on it. So if I say, hey, you know what, that Tesla's doing really good, I'm going to move it up to a 3% because it's actually showing the results I actually like. So yeah, I liked YieldMax. I bought a bunch of them. Some of them are starting to show their age. CONY is obviously showing their age. I don't know what the fund managers are doing with CONY, that CONY is hurting so bad because they used to be a darling. They still, it doesn't owe me anything because I'm almost at house money. House money means that I've gotten more distributions than I've paid for it. I'm at 87% to house money for CONY. So once I reach 100%, basically, I don't care if CONY basically trickles at 2%. I've made all my money back. So, but again, I don't know why YieldMax is having issues with CONY growing because coin's valuation went up dramatically over the past couple of months. And I don't understand that. But the others, I typically go, they're doing the yield that they're doing. Like you've seen Misty's yield has definitely dropped. I've seen a lot of the yields that have definitely dropped. I have a feeling, and you would know better, Marcos, too, because you're more in touch than I am. I have a feeling that I've noticed because Jay Pestrichelli and those guys were getting a lot of pressure from the community saying, you know what? We love ultra high yields, but we don't like it at any cost where erosion is going to be something that it's going to be a constant concern. And I think it was actually impacting their sales enough that they actually started putting more protection in. Like, that they put spreads in now. They've started lowering their yields so that they're not paying out more than they earn. And so I have a feeling I don't mind that. I mean, sure, I would love to have the 100% yields that Misty was doing in the good old days. But if it runs more stable and I could run it maybe at 70% yield or 30% yield, I'm okay with that. So yeah, YieldMax is definitely in my wheelhouse, but I also have Defiance and I have Round Hill. Defiance, they've learned their lesson too. I'm sorry if I'm getting off topic. They've learned their lesson too. I've noticed that their yields are definitely down. They actually put a target weight now, a target distribution of 30%. Yeah, of course, when you bought IWMY and QQQY way back in the early days, you were wanting that 80, 90%, but 30% is nothing to sneeze at. And right now, the value of it is similar to CONY. I've lost a lot of money because they actually reversed split and that, but so the capital value of it is lower on mine. But as long as they keep paying their current yield for me at about, 30, 29%, it's one of those that basically stays in the barn and it keeps producing milk. So that's it. So
in terms of your portfolio with YieldMax, fun fact is that you have about 27% of your portfolio into YieldMax ETFs,
yeah.
with the highest being Pelty, then LFGY, HOOY, MSTY, CONY, AMZ, NVIDIA, YBIT, and then the lowest holding one is ULTY. How do you go about picking YieldMax ETFs, or even just ETFs that are single stock names, and even higher yield ETFs by YieldMax?
The one thing is again, it goes towards diversification. ULTY is the lowest because it's one of my newest. Basically, I just got into ULTY 3 weeks ago. That was one of my July darling transactions. I used my, like every month I produce way more money than I need. So basically what I do is I don't reinvest just because I have to do it. I do it because I can't bring out any more income than I'm doing right now. Otherwise I'll be taxed to death. So I'm only bringing out about 10 or 15,000 a month out of my portfolio. So the rest is reinvestment. It builds up every month and I decide every month with that bucket, what am I going to buy? ULTY was that decision. I really liked ULTY. Now, why would I buy ULTY when I never was buying it before? Because I actually saw changes in how YieldMax was running ULTY. If you look at their chart, you can see a dramatic change, the daily price structure of ULTY. ULTY went from constantly going down and eroding. And then sometime in February or March, they made some changes. They must have put call spreads in and stuff like that. They've likely lowered a little bit of their distribution, but it went from that to flat. And I liked seeing that it was flat. I also loved seeing the high yields. If there's a yield that's doing good and I see that the ETF that is giving that yield is running relatively healthy, like what I'm seeing with ULTY, that's why I decided to get with ULTY. HOOY, I love that one even more. Like I fell in love with that the first time. It sort of caught me off guard, HOOY, because honestly, it's only 3 months old, but I didn't, I'm watching every month or every week when the distributions are declared. I have to enter them in my spreadsheet of which ones I'm doing. So I get the YieldMax listing every week and I sort of skip over the ones I don't have. Sometimes I look at them, but then last week when HOOY showed up with CONY, because CONY, so you want to know why I bought HOOY? YieldMax does things in what's called weekly groupings. So in order to simulate a weekly payout, they've taken all their big popular monthlies and put them into 4 groups. I have 2 ETFs in 2 of those 4 groups so that they can pay a good Friday distribution. Well, CONY was a single ETF in that week 3, I think it is. So in week 3, I only had CONY, but when I looked at CONY, I saw HOOY there paying $6.80. And I'm like, what? Let me learn more about that now. So I looked at it. I saw that the previous one was in the upper $6 range. And the one before that was only 3, but that's because it was inception. So I'm assuming that it would have been 6 as well if they actually had a full month. I'm liking this one. So that one I fell in love with enough that I actually did. And I actually created a video on that, Marcos, basically on my thinking on how was I going to rebalance my portfolio. Because remember, I told you I used all my redistribution or my reinvestment money to buy ULTY, so I had no cash. But then HOOY showed up yet last week and its ex-div date was going to be Thursday. And I found out about it when it declared only 2 days earlier. I was like, okay, I need it, but how am I going to get that money? So I did a major rebalancing and I actually sold and trimmed the gains because I don't want to lose the position. I trimmed the gains of 4 of my other ETFs to get the cash to buy. I now have a full position. I'm actually overweighted in HOOY. I went from nothing to overweighted on HOOY in basically 1 day. So
in terms of the risk of your portfolio, you have a super high allocation to YieldMax, and even you could say you are chasing yield and wanting that income So from a scale of 1 to 5, 1 being the lowest amount of risk in your portfolio to 5 being the highest amount of risk, what kind of risk do you think you're taking in your portfolio?
Actually, I know everyone says it's risk. I'm going to turn around and challenge the thinking. There's not much risk here because remember, if I treat each covered call ETF as an annuity, meaning I'm buying and holding it and I'm going to hold it forever, you already eliminate capital gains out of your return on investments because all you're now focusing on is income. But more importantly, I think my risk is actually quite low. And the reason I'm going to say my risk is quite low because I use Snowball Analytics. And in my Snowball Analytics, it actually takes my entire portfolio and does a risk assessment of the entire portfolio. So forget about the guesses in that. No, Snowball actually looks at my entire $1.6 million portfolio. It looks at all the ETFs and my growth stocks. And it says, here's what your volatility is. Here's what your, now again, I'm sure you know this term, but some of your viewers don't know. There's a thing called the Sortino ratio. The Sortino ratio basically says, considering how much risk you're taking, how much return are you getting on that risk? And the average, if you actually do research on what the Sortino ratio is, basically, if you can exceed 2, you're doing good. I'm at 13.86 on my Sortino ratio, meaning the return I'm getting versus the risk I'm taking is dramatically higher. So I'm not worried about risk. I don't think there's risk at all because everyone thinks there's risk, but honestly, even the ones, there's risk if you actually think you're buying these ETFs to have a capital gain in the future. If you're buying CONY and say, yeah, but the return on investment, you're down on your capital growth by 57%. Yeah, but I'm looking at my charts right now. And right now, CONY is at a positive 33%. Why? Because I actually generated income, even though the capital gain of my CONY is down. So what do I think? I think my risk is extremely low because at the end of the day, even when the markets are down, you're not investing in the company when you're buying covered call ETFs. You're investing in the covered call contracts written on the company. Doesn't matter if you have a pandemic or if you have a Taco Friday like we had on Friday. At the end of the day, these covered call ETFs, yeah, their NAV will go down, but their distributions will continue to pay. So I personally don't think that I'm risking much. And my Snowball Analytics confirms what I'm saying is that they're saying that, no, your risk is actually quite low.
You said it before, like, are you actually making money off of a $1.6 million portfolio with only basically mostly high income ETFs?
Yes. There is, remember I told you 20% of my portfolio is pure growth stock. 2 of those 3, I only have 3 stocks that make up that 20%. 2 of those 3 are real penny stock, high risk. I'm hoping someday in the future I'll make a torque on it. But there is one of my 3 that has been my darling of all. It's my largest investment, actually. It's Athabasca Oil, which I've had since January of 2023. It has made me so much capital gains in its path from when I bought it at $2.18. It's now touching at $6. And I've been doing swing trading on it through the whole path. So I know that stock so well that I can make cash on it almost every few months because I know when it's high, I know when it's low, so I'm always buying. But other than that, even if Athabasca wasn't there helping out with the capital gains, I absolutely can make my income on my 80% that's covered call ETFs. I mean, honestly, the income that I'm reporting is 40 to 50. Now I'm touching into $48,000 a month. That's all because of my covered call ETFs. That's not because of my Athabasca oil.
So you being in retirement, so you're telling me that you could confidently sleep at night with your portfolio with no worries much at all being into all your ETFs?
Absolutely not. So the one nice thing I did, Marcos, before I retired, and this is before I even knew what passive income investing was, I was with RBC. I still am. My brokerage is Royal Bank. But I had a financial advisor, planner, and you know what they do when you're getting close to retirement? They do the right thing. They said, let's sit down and let's do a retirement analysis. What is your lifestyle choices? Stuff like that. And it was very valuable for my wife and I because what it did, we sort of knew how much we needed every month, but it actually nailed it down. You know, they go through an insurance and, you know, you want to travel 3 times a year and all that. So it basically came out to saying, you know what, Perry, you and your wife can live very comfortably at $5,000 to $7,000 a month. Very comfortably. I'm not a guy that has a $2 million home and stuff. We're very happy where we are. We have very, modest means and stuff like that. So I only need about 5-7. I've turned around and said, now we turn around because of passive income investing. I've moved that number up to about 10,000. I'm getting, you know what? I can now go to any restaurant I want. I don't care what the bill is. I'm just buying it. Stuff like this. So I've moved it up from $7,000 to $10,000. And, honestly, if my passive income investing is generating $40,000 a month, it's 3 times more than I need. And in order to make sure that I can sleep well at night, Marcos, I reinvest because it basically says, this is my golden goose. So why would I try to kill the golden goose if I can keep feeding the golden goose with more? So, when we have Taco Fridays like we had on Friday, everyone else, like, if you were a growth investor, you're like, oh my God, look at that. There goes my Tesla stock. There goes all my stuff. I was like in heaven. I bought some great deals on HOOY. HOOY dropped down for 1 hour. It dropped from 67 down to 61. I bought it at 61.95, and an hour later, it was right back up at 65. I'm like, when I see market days like this, I'm not losing sleep. I'm like, it's clearance sale day for me. So no, I have no problem, because I know the reason I like my portfolio the way it is right now. I can sleep at night because even when Trump came out and did the tariffs back in March and we saw the big dip, my portfolio distributions, and if I have a chart, I could show it to you. My portfolio distributions dropped in March and April from 41,000 down to 34,000, 35,000. But the nice part about that is it's not even close to what I need. Like, as long as I can keep my distributions above 30,000, I am far, far, far away from saying I'm going to have to sell my house because I can't live. So yeah, I sleep at night because I trust my portfolio. So
in terms of NAV erosion, what are your honest thoughts on it? And is your portfolio experiencing any sort of NAV erosion?
There's not an all or nothing scenario with NAV erosion. As a matter of fact, I can even show you on my spreadsheet. If I showed it to you, I can show you examples where there is NAV erosion, and I can show you examples where it's just an ETF that's in a very large price decline box. It's in a box between, CONY. I'm on a verge of almost saying CONY, it might have a little bit of erosion, because what disappointed me about CONY is that coin went up dramatically and coin didn't follow up with it. Like, it didn't really follow up. So if you wanted, now again, I don't know why, because CONY was not doing that earlier, but for some reason over the last 6 to 8 months, I think CONY does have a little bit of erosion, and it's only because the fund managers are doing something that is not, in my opinion, is not being done right. Like, they shouldn't be able to do that. Another one from Defiance that has erosion is ULTY, which is my oil ETF. If you look at its chart, it has constantly been going down, 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 very slowly, but it's been going down. It's going down at a level that I'm not that overly concerned of. I've actually bought more ULTY only a month ago. Because again, if I look at the philosophy that I see these as annuities and not as, total return on investment, ULTY is still one of my highest yielders of the American ETFs. Like, it's generating still about 80-90% yield. I'm like, okay, and the price is so low, it's like, I got to get more of those. So yes, there is some erosion, but it's only a onesie twosie. Anyone that turns around and says that all covered call ETFs erode is absolutely zero wrong. I mean, because if you see erosion, go and look at Harvest PLTE. Almost all of Harvest's new single stock covered call ETFs. PLTE, I've made more money on capital gains on PLTE than I've actually made on distributions. So much so that I actually had to trim the profits so I could buy HOOY. So for anyone that says that covered call ETFs erode, yeah, some do. And that's the ones that are just either they're just being too aggressive or they're not running the strategy properly, because you can run these covered call ETFs and run them healthy. I don't consider a price box, Marcos, to be erosion. Like, if I see something go down to, like I'll use my ENCL. ENCL has a price box. It's in a Canadian oil ETF. It has a price box. It trades between 17 and 20. A lot of times it sits at 17. Sometimes on good days when oils are going up, it's at 19 or 20. But as long as it sits in that price box, that's not erosion. That is typical. I could say Tesla is actually eroding, because look at where it used to be at $400. It's like, so are you saying that Tesla is eroding? No, it's in its down cycle. So there is some erosion, but it's not something I worry about. It's something I deal with. I say, okay, for example, with CONY, if I believe CONY is eroding, I'm not putting any more investments in it, but I'm not selling it either. I'm basically just, milking it, let it keep paying my distributions. Because as we talked earlier, Marcos, even if CONY reverse splits and goes back up because of reverse split, it will still keep paying that money. And again, yeah, okay, so if that's one of those erosion ETFs, then fine, that's what it is. And I just won't invest any more in it. I'll go into the ones that are not showing erosion. So the answer is, yes, there is erosion. I'm not worried about it. You just have to deal with erosion. That's all.
So you are in retirement. You've been in retirement for a few years now. In terms of recessions, stock market crashes, stock market pullbacks,
Yeah.
how will you react with your portfolio in those scenarios? And you said, like I said before, in terms of your income dropping during those pullbacks,
Yeah.
how does that make you feel? But overall, how will you react with your portfolio in terms of a stock market pullback?
There's always going to be stock market pullbacks. What worries me is if there's a fundamental shift in geopolitical stuff happening that we now have a dangerous market. If we have a market that's not stable for the reasons of not being stable, as opposed to it's stable, it's just in a downturn. What worries me is if we go into uncharted territories on a market. Well, that's not going to only worry my portfolio. That's going to worry everybody's portfolio. I don't care if you're growth, income, or distribution. But if you're talking about just a normal recession, I'm going to do what I did when the Trump glorious Monday, whatever that day was, happened in April. You know what? That's a microcosm of what I would do if it lasted for a year. At the end of the day, fine, I'm just going to run at $30,000 instead of $45,000. The nice part about my portfolio is I earn way more money than I need. So I have such a buffer that if I have 2 years of the markets going down for, as bad as they are, say a major recession hits, even if it goes into the 28, 29 range, at the end of the day, I still have more. So the nice part about my portfolio is I'm living on my income, even when it's in the bad days, like a pandemic or whatever. In fact, I'm actually going to be enjoying the part of that because remember what I said, what happened on Taco Friday? Those are the times when you can start bulking up on the ETFs that are now underpriced. And you're like, they're going to go back up again. Actually, that happened to me in 2023, Marcos, when was not a great year too. Like it was really, the markets were really down and unstable. I was buying I'm going to use a call, I bought call and bank at some really low prices. Well, I've made so much money on call when I was nervously buying it in 2023 at $8 or $9 or $10. I sold half of its position at $15 this year. So what will I do when there is a recession? I'll be looking for good deals and constantly reinvesting on the good deals, knowing that eventually the recession will go away and it'll go back up again. And those ones that I bulked up on at a really good price, I'll be able to actually maybe trim off some profits and then buy other ones. So I'm not afraid of recessions at all.
So you have a 35% dividend yield. Is it too low for you? Is it too high? Is it just right? And is this sustainable long term?
Yeah, currently my yield is 37.79. I'm just looking at Blossom right now. That's because of HOOY. I don't know what number you saw, but that's because HOOY and ULTY joined the game. When those two joined the game, I increased my yield by 2% just because of those two. I'm happy with a target in the 34 to 38% range. So I'm definitely in the upper end of it. I'm not looking for a yield higher than that. I'm always going to look for better deals. If there's another new ETF that like a HOOY that shows up and says, I'm going to get more of it, I'm always going to fine tune my portfolio to see if I could squeak out a little bit more. So but I'm happy at 35%. 35 is good. If I can get it to 40, that's a bonus because if we have a recession and it drops back down to say 35, I'm just adding a buffer by bringing it higher. So 35 is a good yield for me. My ROI is actually my IRR, which is the more important number. That's the future direction. I'm currently at a 20% IRR. So that's including my losses because right now my capital losses, I've lost $264,000 in capital NAV. So I've invested at 1.8 million. I'm only at 1.6 million or 1.55. So my capital gains is actually a 260,000 loss, but I'm still having an IRR of 20.25%. So I've seen that number go down to about 17, but that's when the March thing happened with the tariffs. I was down at about 17 or 18, but it has recovered. And so, yeah, so I'm good with that.
So you are earning over $480,000, even more now, in dividends and distributions. What do you spend your money on? Because like I said before, you'll be good at 5,000, 7,000 per
Yeah.
month. Now you're at 40.
Yeah.
And whether or not the market goes down with your distributions going down, you'll still
Yeah.
have that big buffer. So what do you spend your income on?
Well, that's actually a really good question. I'm glad you asked that. So in my early days of retirement, I'm basically spending things that I would have never been able to do before I had passive income investing. If I retired with the way I was going to retire, I was going to only make $5,000 to $6,000 a month. I would have just squeaked by and had a comfortable income. Now that I have the numbers you're talking about, the first thing I did last year is we totally renovated our kitchen. We're doing all the me things right now. So I bought a hot tub so I can enjoy my retirement more. We're going to start taking more trips and bucket list items. But that doesn't cut it either because you can only do that so many times. The one that I'm really spending a lot more time on now, and I've actually started it, is I want my daughters. I have two daughters, and I basically want them to be financially independent too. So I basically, and I know this rattles the cages of people saying that young investors should only invest in growth, but my young daughters, they're not young, they're 30 years old, so they're not young, but they're in the midst of their prime of their adult life. My youngest basically has an income that's modest, but it's, if she could get another $500 a month or another $700 a month, that's what she needs now. So why can't I use the same portfolio that I'm using to make one for her? So literally what I'm doing, and I'm sure this is happening in the US as it's happening in Canada. There has been reports that there's the largest transition of wealth from the older generations to the younger generations now in the history since they've been recording it. And that's true. The grandparents handing down their estates, the parents handing down. So I'm starting to do that as early as possible. I've already got my two daughters. I've already handed about 20,000 each into each of their TFSAs. Whenever there's any extra money, I'm going to say, hey, you know what? I'm going to add another 10. I want to get their TFSAs, and that's a Canadian sheltered account. I want to get them up to their maximum headroom, which right now for an adult is about 100,000 each. If I could do that with a 37% yield or a 35% yield, that would give them enough that they could live on it without even having to work. So that's what I'd love to see. I would like to see that them working is an option, not a mandatory. So what am I spending my money on? I want to make sure that my daughters have a life that makes their life as easy and as free as possible. That's where I'm spending my money on, when I'm not spending it on myself. So.
In terms of retiring early, living off of income early, so you're telling me that people can do this if they do this early enough, or maybe they're in their 30s, late 20s, early 40s.
Yeah, I absolutely. Well, we have the king of cover call ETFs doing it at age 35, 40. I mean, Adriano, he only works because he enjoys doing YouTube videos. But I mean, you got an example of him and his wife in Costa Rica. I mean, they did this at age 40. The biggest problem that's holding back the younger generation is the fact that you need to get that nest egg in there. Like, you can't retire when you only have a TFSA of say $10,000 or $20,000. You got to get to that magic, the philosophy and the structure of a passive income strategy. And again, I use it based on it's an annuity. So if you keep filling up with new annuities more than you're actually using your annuities, then yeah, why can't a younger investor like somebody in their 30s and 40s that gets their numbers up to a critical number, like say $100,000 in NAV, so that could generate say a 30 to 35% yield? Yeah, why can't they? Honestly. And again, the other thing about this, Marcos, is if they're generating more than they need, let's say they're generating $2,000 a month, but they don't need it right now. If they could keep reinvesting it so that it actually creates, and I'm going to call it creates more of these juiced annuities, you're just basically building it up higher and higher. Even if your NAV might erode every once, you're still building up more and more of these quote unquote ETF annuities. Yeah, they could. And then when they retire, my philosophy is you should be generating at least 2 times more than you want to retire on. If they need an income of say $4,000 a month, they should be generating at least $8,000 to $10,000 a month, so that they can, 1, have a buffer for bad months, and 2, that there's a portion of that money that could go back for reinvestment so that you can grow your your retirement income, not just hold it on its own, because I know some growth investors say, oh yeah, you're being forced to reinvest that, so you're just paying yourself back. No, I'm not. I'm doing it because I want more of these distribution ETFs in my barn so that they can keep growing in distribution, even if it's not growing as much in NAV. So yes, you can do that.
We are both on Blossom, which once again is a free investing app. You guys can click on the link in the description of this video and in the pinned comment section. Perry, there's so many people on Blossom who are like yourself, passive income investors, high income investors earning. I think you might be one of the highest ones I've seen. Do you get, I guess, criticism or hate from growth investors? Because I'm being
Yeah.
honest, I'm on Blossom as well, and I
Yeah.
think we should all get along. You know, I'm
Agree.
mainly a growth investor, aggressive growth, you could say.
Yeah.
And you're a passive income investor, a high income investor. We have respect for each other, right?
Right.
So do you get any sort of hate or criticism, and what are your thoughts to say to those people?
Yeah, honestly, I don't understand why this is happening. It's almost like they're on some form of jihad attacking us. I don't know the reason why, Marcos. At the end of the day, then to just don't follow the passive income streams. Like, honestly, or if you have it, it's not bad. I don't mind healthy debate. If you can turn around and say, hey, Perry, what are your thoughts? Why do you believe in CONY when you see that the NAV erosion is at 57%? Because I'd really like to know. But they don't take those kind of approaches. They take more of an aggressive, I'm going to show that you guys are all idiots and I'm not, and I know better, even though I don't invest in any of these. So my thought to this is really, I wish they would just take a pill, step back and say, if you don't really believe in it, fine. Hey, I don't believe in your growth strategy not because growth strategies don't work. They don't work for me. I'm an income investor. I consume my portfolio because I'm retired. They're not consuming. They're trying to grow it. And again, more power to them. If they want to do that, I'm not going to sit there and write posts to say, you guys are crazy. Why are you doing this? It's just going to, you're just too volatile. You're going to you enjoy what you do and I enjoy what I do. I don't mind us meeting in the middle and having nice, occasional debates, but it should be more in a less animosity. It should be more in a sense of healthy discussion saying, Perry, you're doing really well here. Can you please explain why your erosion on CONY is the way it is? What's your thoughts on CONY? Like, give me an example of why you don't believe it based on stats on what I'm doing. And I'd love to talk about it. So I really would like to see the numbers coming down. Unfortunately, it just seems like we get these waves of them. And again, it gets the hair up on all the passive income investors. If you don't agree with our strategy, great. Just say, I don't agree with it. I think you're doing it wrong. But at the end of the day, you do you and I do me. So
do you ever get thoughts or, I guess, comments from your daughters or maybe even your spouse in terms of, Perry, where you're getting all this money from?
Yeah, well, to be honest with you, at first when I started the strategy, my wife was nervous, especially when we cashed out our pension. That was like the big one. And I can't show you because it's covered right now. But I have a whiteboard behind me. And when we were deciding should we commute the pension or not, because the tech engineer in me basically does everything by pros and cons. We wrote out a complete spreadsheet that said, why are we considering commuting versus not commuting? And all the numbers, when you go on facts, basically said this works. So she was nervous at first, but now after 2 years and basically seeing that our income is actually going up every month, January 2024, our passive income was $19,000. I'm now generating over $45,000 and a year and a half later. So at the end of the day, if there's cracks, she's now finally seeing there are no cracks. We're seeing the rewards where we can now, give this money to our daughters and make them have a better life. So my youngest daughter, which has actually just joined Blossom just last week, she's actually going to take the bull by the horns. And because she sees that this is a way of maybe she can retire early at 35 or 40 or 45, she says, I can't do that if I don't understand how this works. So very proud of her that she's actually joined Blossom and she's now starting to learn this. And I'm sort of hand holding her, learning it. I don't want to just tell her what to do. I want to show her how I'm doing it so that she can make her own ETF buying decisions.
In terms of goals for your portfolio, so you said your goal isn't to grow it to, I don't know, 3, 4, or 5 million. Is your goal to increase the income every single month, every single year? And if so, what is those numbers?
My goal is to make sure that my monthly distributions, not yield, the yield percentage take it or leave it, because you know something like CONY. If you look at CONY's yield right now, if you don't look at yield on cost, your yield is actually really high because at that price. So I really don't care as much about the percentage. 35% is nice. I care that I can maintain about 40,000 to 50,000. So my goal will always be to tweak my portfolio so I can squeak another $500 or another $2,000. So my goal is to keep growing or maintaining my portfolio average. My average right now, because of ULTY and HOOY, my average has gone up to 43,000. I don't care what my monthly one is. The average is the one that counts. If I can move my average slowly up, say $500 a month or whatever, that would be a good goal. Like, I'm not saying that I'm going to try to attain it, but doing that would be my goal. NAV, I don't care about hitting 2 or 3 million. I care that my NAV stays in what's called a stable, healthy box. So to me, if my NAV can stay between like when we had the tariff, my NAV dropped to 1.29 in down back then. Yeah, it made me nervous, but not nervous because I thought, oh God, it's never going to recover. It made me nervous because I thought that there was a geopolitical movement that could actually destroy the markets. And is it even safe to invest in the American markets anymore because of the instability? That's what kept me up. But as long as the markets stay healthy, I don't care that my NAV is at 1.2, because look at this, 5 months later, I'm back at 1.6. So as long as I could stay in the 1.3 to 1.8, I'm happy. I don't care if I go beyond it. I'm caring that I'm juicing more income out of that box, that NAV box of 1.3 to 1.8 is really my goal.
Bonds. Bonds are a huge topic.
Yeah.
So what are your thoughts on bonds? Because people think, okay, I'm in retirement. I need about 20% of bonds, 10% of bonds, some cash on hand. You don't have any bonds to my knowledge, so I'm going to throw it back to you.
Yeah, I don't have a bond, but I have one bond ETF. I have one covered call ETF. It's HPYT. It's not been doing good. I mean, I won't call it NAV erosion, but the bond markets have been hit, for a couple of years now. So I bought it at $11 or $12. It's down, I think, at $9 right now, HPYT. I'm not down that bad. I'm down 11%. That's my only bond ETF, but I don't buy it because of bonds. I'm buying it because, again, I want diversity. And the one thing I didn't have diversity on is I didn't have diversity on the bond and treasury markets. Everything was on equities and Bitcoin and digital currency. So I do hold HPYT. I won't get rid of it because I do want the diversification of having bonds in it. Holding bonds in a portfolio in general, my strategy is different because my strategy is all based on income from contracts written on, covered call on underlyings. But in general, bonds are boring to me. The yields are really low. And I'm just like, man, I could do way much more with that same money if I put it into something else. I don't believe in that. I'm not one that will follow traditional statements that came from the investment community in the 20 or 30 years. Like, I know there's another one that says when you retire, you should follow the 4% rule. I absolutely do not believe in the 4% rule because that only works when you are a growth investor and you need to melt down your portfolio. Well, my portfolio is not melting down, so why would I have a 4% withdrawal rate? My biggest account, which is a LIF, it's basically a locked-in retirement account. I can only take so much out of it. It's actually growing because I can't take enough money out of it. So my RIFs, I don't know in America what they call them. We call them RIFs, retirement income funds. Our retirement income funds, I'm actually growing in them because I'm making more money than I can actually pull out of them because of tax reasons. So I don't believe in a lot of people that turn around and have this thing. Well, they've said for 30 years that when you retire, you should follow the 4% rule. You got to reevaluate because in my opinion, covered call ETFs are game changers in the investment industry. They didn't exist 20 years ago. Matter of fact, they didn't exist even 15 years ago. I think Canada created the first one back in 2016. So you can't use old rules and logic when you have new players on the field. So you got to really rethink things. So when you say things like that, I'll always challenge, I'll challenge all the rules with regards to saying, does it fit with the new tools on the table, right?
Is passive income investing underrated or overrated?
Underrated.
How do you invest in ETFs? Is it lump summing? Is it dollar cost averaging? And which one do you think is best?
Lump summing is the worst way. I hate doing it, but when somebody has actually got basically a lump sum, they sort of like put it in. Even if you do put a lump sum in, and unfortunately we're going to have that kind of, because I know people that are transitioning from the old portfolios to the new ones. They're like, okay, I just sold my mutual fund. I got $100,000. I'm going to buy all my ETFs. I did it myself, but I don't like it because you're buying into a market at the wrong time. So I don't believe in lump sum. Even when you have a lump sum money, you should really try to wait for down markets and try to DCA at it.
Will you ever use margin or leverage in your portfolio?
I've used it a couple times. And again, it was scary. I did it my first time last year. I have a HELOC, a homeowner line of credit. And basically, I saw my Athabasca, which was my darling stock, at a really, really low price. And I didn't have the cash to cover it because my monthly investments hadn't paid yet. So for 2 weeks, I actually borrowed money to buy the Athabasca, but then I paid it right back. I don't do long-term margins, but I will, on a rare occasion, do it. I do absolutely believe in leveraged ETFs, though. If there's a difference between one that's not leveraged and one that is leveraged, I will always buy the leveraged cover call ETF.
So what are 3 tips of advice you would give to somebody who wants to be a passive income investor like yourself with maybe $1 million plus in their portfolio and yielding $500,000 one day in their portfolio?
To learn the logistics. Again, a lot of people are asking me, Perry, first of all, can I tell your audience, I will not take payment to be a consultant. I've had a lot of private messages saying, hey, I want what you do. Can you please, I'll even pay you. I'm just an average investor. I am not trained. I'm not a financial advisor. So in case anyone didn't know that, I don't know anything that's expertise. So I will not do consulting. And even when I do advice, Marcos, I only do it on a per question basis. What do you think of this? I'll tell you this, but I'm not going to tell you what to buy and stuff. So that being said, I would advise people do what I did. Get a desire and an inspiration that you want to do it. My daughter just got it a couple of weeks ago. So first of all, get inspired. You have to get inspired that you believe this is the way to do it, but I just don't know how to do it. Then I would turn around and use the resources of Blossom and the influencers in Blossom. I actually, almost every time somebody starts and says, how do I start learning? I always send them to Adriano and said, become his follower, follow his YouTube channel because he's got great videos. For me to do what he's done after years and years of these videos, watch his videos, watch other people's videos. And then the next step I would say is just walk one step at a time. Like, don't think you have to do what I'm doing in 6 months. Even if it takes you 2 years, do it one step at a time. I would then turn around and I recommend to everyone do this, create a practice account. I mean, with RBC, you could create a $100,000 practice account and start buying and selling these ETFs and watching for a month. How is it going? Get comfortable with them. Get to know these ETFs. So don't run. Go slow. Go steady. Use the Blossom social media and ask dumb questions because there's no such thing as dumb questions. They're always dumb just to the person that was above them. So I always will answer any questions anybody says. So go slow and go steady, but have a drive that you want to get there and you will actually get that same goal.
Shouting out your YouTube channel. And of course, everybody, please go ahead and follow Perry on Blossom. And even please go ahead and subscribe to his YouTube channel because I actually watch a lot of people's videos and I love your videos.
Oh, thank you. Well, I'll say I'm brand new to the YouTube channel. So thanks, Marco, for calling that out. I've only created 4 videos as of yesterday. I'm brand new to it. So, if you want to try to help me out, I'm trying to provide a lot of good information on my YouTube channels. I go from extremely advanced YouTube videos like the one about the deep dive on my spreadsheet to the one I released yesterday that was so basic. It's like I'm just starting. So if you subscribe to me, I'm going to be doing a good mixture of high and low ones. And I would love to have anyone's support if they like the content. If you don't like the content, don't subscribe. But yeah, I'm actually loving this journey. I can't say enough about Blossom and about all the other influencers, the up and coming influencers like Paul and that. It's nice to see people like me. I never thought in my mind I would ever be any form of an influencer. I just came here just to invest and talk to people. So it's great that the community is actually supporting itself. And I'm happy to be on Blossom and I'm happy for your support. So
now, if you guys like this video, please give it a like because this cute puppy did. And go ahead and check out our last interview with Paul from Blossom right here on your screen. I love you guys so much, crushing the stock market, and take it easy. Peace.